My name is Meghan Noone, and I work at a company called New Hampshire Federal Credit Union. And I'm in an amazing department here at the credit union. I'm in what's called the Center for Finance and Education, and I'm a financial wellness coach. And what I do, whenever I tell people what I do for a living and I give them my title, they go, "Oh, do you like help people with like retirement and stocks and bonds?" And I say, "No, no, 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 no. Don't ask me any of that. I have my own personal background in that, but I am not licensed or anything there. What I get to do all day long is help people with their financial world, whether that is building their credit, repairing their credit, learning how to budget, learning how to save money, giving them education on things like credit. Some of the things I'm going to share with you tonight, I'm pretty positive a lot of you are going to go, "Really? Are you serious? I did not know that." There are so many credit myths and misconceptions out there. And I'm going to be, as I'm talking further through this, I'll be talking a little bit more about what I do and how we might be able to help some of you out there on a one on one basis. And also at the end of this, I have let them know that I am available to do any further financial coaching, financial classes, and would definitely love input from everyone on what types of classes you might be looking for. And at any time, you can enter that information into the chat, or I will certainly leave a moment at the end, a minute or so at the end to do that. But if you're sitting there while I'm talking and you're thinking, and I mentioned, say, Dave Ramsey, and you're like, I've heard about this Dave Ramsey guy. I'd love to find out more about him. Go ahead and put that in the chat, or any other types of financial education that you're thinking might be useful to you. Please let us know. We can get something scheduled, or I can send you materials based on things we've already done. So, again, just quickly before I get into my presentation, everything that I do at the Center for Finance and Education is free, which is pretty awesome. So, on top of webinars that we do and in person classes that we can now do now that COVID is lessening a bit, we also offer one on one financial coaching, like I just mentioned. This is free as well. And the contact information for the Center for Finance and Education is up here on your screen. And the lovely ladies that are helping me out will be sending you a copy of the presentation tomorrow, along with my contact information. So no, you don't need to take notes unless, of course, you want to, but just letting you know that. And when I reach out to them tomorrow to reach out to you, I'll include a flyer on our financial education again. But what we do is if someone wants to talk about, after I do a lot of these classes, a lot of times I'll have people reach out to me and they'll be like, "Megan, that's great and good education, and I learned a lot, but how can you help me specifically with my specific problem, with my specific life?" And that's what the one-on-one coaching is for. It's free. We'll help you do anything that you are looking to get help with financially. Sometimes that is helping people work on a budget, get themselves on a budget, improving your saving habits or starting your savings habits, working on your credit. If you have loans out there at high interest rates, I partner with an amazing lending team here at the credit union that are happy to talk to you about any of the loans you have. And most importantly, I have two full-time coworkers that work along with me. We are a happy bunch of people. We have a ton of energy. We'll be your biggest cheerleader. We'll be your accountability buddy. And we are here. We won't stop until you stop us or you get where you need to go. That is our goal. And I have many people that my coworkers and I have worked with that were not in great financial shape and now are owning their own homes, have thousands of dollars in the bank, have 750 credit scores. So it definitely can happen. And this is my teammates and myself. So again, my name is Megan. I'm on the left. My coworker Debbie is in the middle here, and then also my other coworker Kim is on the right. So we are Center FE. So credit, how does credit impact your life? It can impact your ability to get loans at all. And if you can get a loan, It might impact your ability to get a good interest rate on that loan. That's actually a concept I'm going to be talking about in this presentation. To buy a home or rent an apartment, even renting an apartment nowadays, landlords will actually ask you to, you'll give them a check for $30 or something when you put in your application. They want to run your credit. Buying a car, getting a job, not all jobs, but I work in the financial industry. When I got the job here, I had to not only pass a background check, but I had to pass a credit check. And if you think about it, it makes sense. How can I possibly educate people all day on what to do with their money if I could not manage my own? And the last button I have here, which is a little strange, is getting married. And every time I use this one, people look at me funny, but we get married for better or for worse, right? And not even getting married, maybe just joining finances, moving in with your significant other. You're combining things and you're getting their better and their worse. So if you're somebody that has done a good job saving money, really built up your credit score, do you really want to combine your credit, your money, with someone that spends all the time and doesn't pay their bills? So it's just something to be mindful of. Now, I don't want to break up any marriages or engagements here tonight. I don't want anything like that. But I work with a lot of married couples on just this type of thing because we're all different. We all have different attitudes towards money. We all have different values towards money. We're not all the same. So a little bit of terminology for us to start off. Your credit report and your credit score. So your credit report is a history of how you've paid your obligations. When you look at your credit report, and I'm going to show you later how to pull it, you're going to see every credit card you've ever had, every car loan you've ever had, student loans, anything like that. You will see any bankruptcies you've had. You'll see every name you've ever had, maiden name or divorce name or what have you. It's an entire history of you, of your credit. And then you also have a credit score, which is a number. And this number should range from 400 to usually 850, depending on the bureau that we're talking about. And the higher your score is, the better your score is. So how does credit work? So you need to be at least 18 years of age in order to start establishing credit. And the types of things that will be on your credit report that are considered part of your credit history are some of the things I just mentioned. Credit cards, mortgages, student loans, personal loans, car loans, motorcycles, all of that. And some things that are typically not included are rent, cell phone, utilities, although I am going to talk to you about a way to get some of those included, which is pretty cool. Some of the other things that are going to appear on your credit bureau, if you have them, I mentioned bankruptcies, but also collection accounts. I see collection accounts all day long with people that I work with. Actually, a lot of people have collection accounts now. Many people have medical collections, simply just because insurance companies just do not cover the things that they used to. And my advice to anyone that has any collection accounts, get them paid off as quickly as you can. They're going to stay on your report for a minimum of 7 years, perhaps longer. They are going to drag your score down, and they also don't look good at all. If you are going to apply for a mortgage and the bank, the credit union, the mortgage company sees collection accounts, they're going to want, at the very least, they're going to want an explanation, a detailed explanation of what that is. You're definitely going to have to answer some questions. So there are 3 credit bureaus out there: Experian, Equifax, and TransUnion. And it's always been a little weird to me, well, it's always been a lot weird to me, that there are 3 different bureaus. The way I always look at it is, okay, I get a loan, you use my social security number. It just needs to report to one agency and we should be done. But that's just not how it works. So it's important to know that not everything that you do, not every loan that you get, not every collection account that you might have is going to report to all three bureaus. Especially collection accounts, they typically will only report them to one bureau. Most banks and credit unions, unless you're applying for a mortgage, most banks and credit unions only run your credit through one bureau, or maybe two. And then you go apply for a mortgage and they'll do something called a tri-pull, a tri-merge, where they'll pull all three. So like I mentioned, I'm going to be telling you later how to pull your credit bureaus, but this is actually a story that happened to one of my clients just last year, because she came in to apply for an equity loan. And she came in to talk to me because she thought her credit score was great. She had gotten loans, car loans, credit cards. As far as she knew, her credit score was over 700. And it was in Equifax, and it also was in TransUnion. But in Experian, she had medical collections that she was making payments on, but had not paid them off in full yet. And when you're just making payments on your collection accounts, it's a good thing to do, but it won't help you until they're completely paid off. So this woman had a 715 credit score on two bureaus and a 585 on the third bureau, which is a huge difference. And again, these are things that not everybody knows. So I wanted to make sure that I brought some of this stuff up tonight. So like I mentioned, your credit score is a number. The larger your number, the better your credit score is. You want your credit score number to be as high as possible. Usually on the low end, it's anywhere between 4 and 450. And typically the high end is 850. And I have people tell me all the time, Megan, I'm not going to stop until I get an 850 credit score. And while that's a wonderful goal, you don't need an 850 credit score. You don't even honestly really need an 840 credit score. You need to have your credit in the highest tier possible, which is typically about 750 or higher. If you're someone that wants to be getting a mortgage in the future, you want your credit score at a minimum to be 650 if you are planning for a mortgage. And I encourage folks that are looking to be homeowners at some point, don't shoot for 650, shoot for 700. The higher your score is, the better rate you'll get. The higher your score is, the more options you'll have out there. People will be fighting for your business, not the other way around. So if your score is in the 700 range, as you can see on my graphic here, you're either in the great range or you're doing very good. Most people that credit score is 700 or higher, what I talk to them about is maintenance, maintaining where you're at. But I hear a lot from people, they're like, well, my credit's terrible. I'm like, okay, it's okay, it can always be improved. What's your score? Oh, 680. I'm like, that's a good score. Like, put your head out, can it be better? Sure. Are you going to get every loan you want? No, probably not, but you'll get a lot of them. Are you going to get the best interest rates out there with a 680, 690 score? No, but you'll get probably decent ones. Again, room to grow, of course. But if your credit score is in the high 600s, I'm pleased with that. That means that we can work further to get it even higher, but that you're starting off in a good place. And if your score is, under 650, it's considered not good. I normally cross off before I do these presentations, not good and bad, because I don't believe in negative stuff. I'm just not into it. So if your score is under a 650, what I tell people is that your score is a little bit challenged. It needs some help. That's all. Hey, don't we all, right? risk-based lending, and this is a term you probably have not heard before. It is something that most banks, most credit unions, car dealerships, they all used risk-based lending. We actually do not. And I'm going to talk about that in a minute. But what risk-based lending is when you, a bank, a credit union, a car dealership, car financing, they will use your credit score to give you an interest rate. So you might have, at some point at your local bank or credit union, you might have seen an advertisement or got an email, car loan rates as low as 1%. And you might go in there and say, great, I want to take advantage of this new car rate for 1%. And they say, well, the good news is we'll approve you, but your interest rate's 9.5%. That's because the people with the best scores get the best rates. And if your score is a little bit worse, then your rate is a little bit worse. Essentially, the better your score is, the better your rate. The lower the score is, the worse your rate is. New Hampshire Federal Credit Union does not believe in risk-based lending. We're the only lender. I know there's other banks and credit unions out there that don't do it, I'm sure. None that I'm aware of, none that I have worked for in my years in banking. And here's why we don't do that and what this means. So if you go to our website, which is www.nhfcu.org, if you go to our rates and you want to find out, okay, well, what rate would I get on a car? You'll see the rates are all posted there. Anyone that is approved, that's the rate they get. There's no, well, you get this and you get that. We don't believe in risk-based lending because we don't believe in kicking people when they're down. It's just not what we do. We are very much in the business of helping, not continuing to hurt people. And if you have a car loan with an 18% interest rate, and this is the type of rate I see all the time in the work that I do, you're probably paying $500 something a month for a 6-year-old car. That's a lot of money for something that's older. Unless you're driving like a Lamborghini or something, I don't want to be paying that much for my car. And many times it's because your interest rate's high. So what I would love everyone to do, or do it or not, but when you're done tonight or tomorrow, when you're thinking about it again, go online to, the company that holds your car, your boat, or your motorcycle. Check out what your interest rate is. If you don't think it's very good, reach out to me, because regardless of your credit score, if I can get you approved, you'll get our best interest rate, which is, again, good for everyone. So how do the credit agencies come up with this number, this credit score number that is so important that it literally affects so many things in our life? Well, it's a pie chart, as you can see here, and the number one thing to do to make sure that your credit stays where it is or continues to improve is make your payments on time. You don't want to be more than 30 days late. Once you're 30 days late, it's going to be reported to the credit bureau that you have a late payment. That is automatically going to drop your score. And sometimes it can drop it significantly. And it also, again, doesn't really look great to have late payments. So if you're 10 days late, 20 days late, 25 days late, you're okay. Anything more than 30 days, it's going to affect your credit score. And the amount owed, that's the 30%. So 35% is your payment history, making those payments on time. Another top piece of the pie here is 30% amount owed. That is how much debt you have. Mortgages, cars, student loans, credit cards, personal loans. That impacts the amount that you owe. And another huge factor is this. Say you have a credit card that has a $1,000 limit, okay? So your line of credit's $1,000. And your balance on that credit card is $900. That actually doesn't look good. It'll actually give you, it might not give you negative points, but it's not going to give you any positive points, because according to the credit world, oh boy, Meghan has $1,000 line of credit on this credit card. Her balance is $900. Geez, that's real close to that limit. Ideally, you want to keep any credit card balances you have 30% or less than what your limit is. So using that same scenario, if I had $1,000 credit card line and my balance was $300, that would actually look good. That can actually give me some positive points, or at least it won't give me negative points. There's 3 other factors that go into your credit score. Length of credit history is at 15%. New credit, which is how many different things you've applied for in the last couple of years, is 10%, as well as types of credit used. And I know that some of you on this presentation here tonight are, well, let's face it, you're younger than me. And, when you're younger, it is more challenging to sometimes get credit. And I'm actually going to talk about that coming up. But if you do have a credit card that was maybe your first credit card that you had when you were 19 or 20 years old, and you don't use it anymore, I advise people to keep it open, unless of course it's, get an annual fee or, something like that. But I advise people to keep it open because it's actually adding length to your credit history. And when you're a young adult just starting out, this is going to be a very important factor for you, how long you've actually been able to use credit. Because let's face it, you can't start building credit till you're 18. So if you're 20 years old, you've only had 2 years to do this. So challenges many young adults have is they just don't have enough credit to have a good score. You might have a car loan and your student loans, but they're in deferment. And your credit score might be, a 600, and you're going, wait a minute, I've made all my payments on time. And the reason that your score is as low as it is because you just don't have enough credit. You don't have enough of a history. You just don't have enough to boost that score up. And if you're a young adult that is struggling to get credit on your own, that is a real problem. You might be able to get a car loan or a motorcycle loan or a credit card, but the company might require you to have a cosigner, a parent, a guardian, a close friend that has a good credit history and a good credit score and can be on the loan with you so that they'll give it to you. And not all of us have someone in our lives that could be a cosigner or a joint person on the loan with us. I know for myself, growing up, my parents had, okay credit, but I'm the oldest of 3 kids with 2 younger brothers right behind me going to college. My parents could not tie up their credit with my problems. They had their own stuff to deal with. And that's real. Many young adults as well, we go from living in our parents' house and everything's, kind of taken care of, and then we move out on our own. And it's eye-opening, right? At first, like trying to be like, oh my gosh, like, yeah, I have to buy like toilet paper and like food, and I need to go to the bank to get quarters to do laundry. It's a lot at first. And especially when we're just starting out, many of us don't have the income to support kind of what we're doing. You might have been used to going to Starbucks every day when you were living at your parents' house and, going out to eat kind of whenever you wanted to. And that was all well and good, right? When you weren't paying rent and utilities and all these other things, but now you are, and you're like, oh my gosh, where is all my money going? This happens a lot. And again, we're here to work with people that want it for free. And many folks as well do not have the education to know that they're putting themselves in a bad situation, or they know, but they don't know how to get out of it. And I was chatting with Ani and Brianna, when this first started, and I said, many people do not get any sort of financial education in middle school, high school, college. I don't know about you all out there. I got none of it. In college, the financial education I got was, oh, you need more money for loans? Just sign here, Megan. That's not, trust me, that is not financial education. It's something else, So in order to get credit, you might have to have a parent or guardian or someone co-sign, or the bank or credit union might say, we'll give you a secured credit card, which means you give us $500, we hold it, and then we give you a credit card with a $500 limit. And that's fine, it works, except you're out $500 until you close out the credit card and get your money back. So again, these are definitely challenges that many young adults have. And the two best things you can do to improve your credit score, like I mentioned, pay your bills on time, no more than 30 days late, and keep your credit balances low or none, but keep them as low as you can. Try to keep them under that 30%. And the two worst things you can do for your credit, pay your bills late, that'll do it every time, and allow your debt to go into collections. And I can't tell you how often I hear this type of story. Someone says to me, well, I have $103, from Comcast in collections, and I'm not paying it. Okay, what's going on? Well, that was my ex-boyfriend or ex-girlfriend or ex-roommate's job to pay for that, and they didn't, and it's their problem, it's not mine. Or the Comcast, they overcharged me, it's their mistake. I get all that, trust me. Pay it anyway. The only one it's hurting is you. Comcast does not care that you owe them $103. Your ex-significant other, not affecting their credit. They haven't probably given it a moment's thought. Only one it's hurting is you. So again, if you have these things out there, I always encourage people to pay them as soon as they are able to. So examples of things that affect your credit score, I've talked about quite a few of these already, or probably all of them. The amount of loans you have or don't have, keeping your balances under 30% on your credit cards, avoid late payments, and also avoid going over the limit on your credit cards. What does that mean? So if you have a $1,000 line of credit, your balance is $985. You make your payment late that month, and they charge you a $20 late fee. So now your balance is $1,005 on a $1,000 line. So they say, oh, you're over the limit. We're going to charge you a $20 fee on top of that. So now your balance is $1,025. And these are things that will hurt your credit score. And quite honestly, folks, can just be really hard traps to get out of. If you have a high interest rate on your credit cards, and the average credit card has an interest rate of 20%, so that's high. So say your balance is now $1,025 and you send them a $40 check. So much of that is going to go to interest. They might say, well, thank you for that. Instead of $1,020 balance now, your balance is $1,011. Oh, and sorry, you're still over the limit, so here's another $20 late fee. I've seen it. It happens. Not having credit or not having enough credit actually will hurt your score. I'm going to talk about that coming up. And I mentioned bankruptcies as well. A bankruptcy will stay, or a short sale or something like that, will stay on your credit report for 7 years. However, it does not mean you can't get loans. And it does not mean that you cannot grow that score in that time. I have absolutely seen people with good credit scores that have a bankruptcy from a few years ago. It's all about how everything else is doing. It really is. Some ways to build your credit. And I mentioned already, authorized signers or co-signers, or a secured credit card or loan. Something I wanted to mention is Experian Boost. You might have seen the commercials on TV or online or what have you. Experian Boost is free. What you're able to do is actually link up your debit card, your checking account to Experian Boost, and it'll start giving you good points for doing things like pay your rent, paying your cell phone, paying your cable, your utilities. And if you pay these bills late, Experian Boost will not give you negative points. They're only into positive points. And again, it's free. So it's not, again, it's Experian Boost. It's not Experian TransUnion Equifax Boost. So it's only going to boost your Experian score. But the two credit bureaus that are most widely known, the two credit bureaus that are most commonly used are Experian and TransUnion. So a way to boost your Experian score for free, I'm all for it. Another great way to build your credit is actually an amazing product that we have here at the credit union. I just talked about Experian Boost, and it is what's called the Credit Builder Loan. So I'll start with the good news on this, and it's all good news. It really is. So with this particular product, as long as you're 18 years of age or older, you're automatically approved. Done. The interest rate is 0%. Yes, 0. This particular product, ladies and gentlemen, does two things simultaneously. It helps you build your credit or repair your credit, whatever you're trying to do. And it also helps you save money, both at the same time. And this is how we do that. So it's a 12-month loan for 1 year. You make the decision if you want to borrow $1,000 or $2,000, or we have had people do them for $500 as well. And if you're going to borrow $1,000, your monthly payment's going to be $83.33 for 12 months, which is 1,000 divided by 12. Look. So for a traditional, think about your car loan, right? So you get the car and then you pay them back every month. That's how a typical loan would work. You get a personal loan, you get the money, and then pay the bank or credit union back. But this actually works in reverse, which is really nice. So you tell me, Megan, I want to do a credit builder loan. I want to borrow $1,000. So perfect. So I'm going to set you up. So you're going to pay us $83.33 a month for 1 year. And every month when you make your payment, counts as an on-time payment. Good job for the credit score, helps boost that score up, starts giving you more of a credit history. When that year is done, you have paid us $1,000. We're going to give them $1,000 back to you. You haven't lost a penny, 0% interest. So at the end of that year, you'll have $1,000 to go on a vacation, to put towards a debt, down payment for an apartment or a car. And what a lot of people end up doing is they like this product so much that they've worked it into their budget that they just make this payment every month. And they end up, after the year is done, they end up doing another one because they're like, this worked. It forced me to save $1,000. Not the worst thing in the world. So again, this is a great product for people hoping to build and or repair their credit, as well as those of you out there that maybe you're just not the best savers in the world. Doesn't mean you're not good people. Trust me, there's so many of you out there, and this will help you do both. All right, so you've probably heard of some of these, Credit Karma, Credit Sesame, and Credit Wise. They're all free. They're all great, and they basically do the same thing. They're credit monitoring that helps you keep track of your credit score, and it will actually give you alerts and tips on how to improve it. And it'll also help you to be aware of any fraudulent activity. If you are signed up to get text message alerts, if anything changes, and all of a sudden you get an alert that you just tried to take out a Walmart credit card, and you're like, no, I did not. You know right away something's up. And all of these are free, and I strongly encourage everyone, again, they all pretty much do the same thing. I strongly encourage everyone to download at least one of them. And again, check it on a whatever regular basis, weekly, monthly, quarterly, whatever, to see how things are going with their credit. So what information's on your credit report? And I talked about some of this already. So all the names you've ever had all the addresses places you've ever lived, places you've worked, phone numbers you've ever had, they're all going to be on your credit report. Like I mentioned, old credit cards, old car loans that you paid off 5 years ago, 10 years ago, they're all on there. Everything's there. Any of your current credit, so your current car loan, your current motorcycle loan, your current credit card, all there. Collection accounts, bankruptcies will all be listed. And you can see on the bottom of my screen account history that they actually give you some graphics for current, 30 days late, 60 days late, and so on and so forth, as well as repossessions, foreclosures, and charge-offs. So all of those things are going to be listed on your credit report, along with your score. Should also be on there as well. And if you look at the top right of my screen here, you'll see that this Joe credit report, it was a tri-merge report, obviously, because you can see he has a TransUnion score, an Experian score, and an Equifax score. And they're all a little bit different. And again, each company weighs things a little bit differently. Each company, might know, Experian might know that you have a collection account, whereas TransUnion and Equifax don't, and so on and so forth. Or maybe one of your loans just reports to Experian and you had a late payment 5 years ago, but it didn't report to the other two, and that's the difference. And again, these numbers aren't far off at all. But when you pull up Credit Karma, CreditWise, it's a really good tool, folks. It's gonna give you an idea of what your credit score is. It's not gonna be exact, but it's gonna get you right in the range, and you're gonna know where you're at, where you're heading. As well as what I really like about it is it gives you tips to clean things up to get your score even higher, ideas for that. So we've talked about how to pull your credit score to find out what that number is. And this is a way that you can pull your credit bureaus for free. And I encourage everyone to do this, especially if you are getting ready to apply for a loan, especially if you're getting ready to apply for a mortgage. Many times when you run your credit, if you apply for something and it runs your credit, it might actually drop your score temporarily. That's what's called a hard pull. By going on annual credit report, it's actually what's called a soft pull. It will not affect your credit at all. Annual credit report will allow you to pull your credit summaries, your credit reports on all 3 bureaus. And typically, in a typical year, you're allowed to pull each bureau once a year. However, right now, because of everything going on with COVID, annual credit report is actually letting people pull their bureaus more often. And if you go on their website, and I put it right here for you, you'll be able to do this on your own. If you'd like some assistance with it and or going through it, or after you pull your reports, you're like, what on earth does all this mean? I'm confused by half of this. Reach out to me. I'll happily, we'll schedule a call, an email session, a Zoom call, in person, whatever you want to do. And we'll go through it with you. That's what we do. And this will give you a really good idea, folks, of what's on your credit summary, because a number is great, but it's just a number. I'm way more interested in how you get to that number. If someone tells me their credit score is 640, I'm like, okay, so why is it a 640? Oh, I don't know. I'm like, well, that's what we need to figure out. We need to figure out why your score is what it is so that we can educate you on how to improve it or maintain it, depending upon where you're at. And for those of you that have student loan debt or student loans in deferment, or may have questions since former President Trump had let us not pay our student loans for a while, and this won't be happening forever. We do not deal with student loans per se at the credit union. I have limited information on them, but we partner with the lovely folks at NEF, which is New Hampshire Higher Education Foundation. And I gave you their website right here. and they're lovely over there. They're beyond intelligent, very knowledgeable. And if you had any questions about when your student loans are going to be due, about trying to switch to a different payment plan or refinancing options for them, these are the folks to call for sure. So when you have a credit card, you get a statement, and you are required by law to get a statement every month, whether it is paper in the mail or online statements. But there is a requirement by law that you are to have receive a statement each month. And the following information is also required by law to be on there. The due date, your balance, your interest rate, your minimum payment. And then, and this is what I find the most interesting, me personally, if you look at the graphic towards the bottom of my page that has the 3 arrows here, they're also required to tell you, okay, if you make just the minimum payment, it's going to take you this many years to pay it off, and you'll end up paying X amount of dollars in interest. So if you look at this person's balance, this person owes $507.35 on this credit card. You know, that could be a new laptop that they had to get because they were working remotely or what have you. That's not a big balance. And you might look at this and go, oh yeah, I only have to pay $10 a month, and like the first 90 days, I don't have to pay anything. Like, yeah, sign me up. That's awesome. Well, it is, except if you look at the graphic here on the bottom, if you only pay $10 a month towards this bill, it's going to take you 7 years to pay over $500. Now, in 7 years, the computer definitely is not going to work anymore, I'm sure, or it's going to be beyond outdated. You probably don't even have the job you had when you bought it, or if you bought it for your high school kid, he's now in graduate school. Do you really want to be paying this over the next 7 years? And if you look on the second line of that graphic, if you not even double your payment, pay $18 a month versus $10, which is what you owe, as you can see here, it's only going to take you 3 years and a lot less in interest to pay this off. So definitely take a look at your statements, folks. Know what your interest rates are. Know about, when your payment is due. Know how much is your minimum payment. And definitely know this information. If I'm only making my minimum payments, how long is this going to take me to pay it off? Some credit card do's and don'ts for you. Definitely shop around for the right credit card. And again, you might not, if you're young and you don't have a lot of credit, or your credit score is just not that great, you might not have as many options as other people. We have a credit card here that has an interest rate of 12.9, which is, in my opinion, very low. I also recommend the website NerdWallet. They have a lot of different types of credit cards. You can put in like best credit cards for young adults, best credit cards for travel points. You get a whole bunch of different options there. Definitely keep track of your purchases. One of the hardest things about credit cards for me is that people just swipe, and they forget swipe and just swipe, and they don't really track how much they're actually spending. And then you get that credit card bill in the mail and you're like, oh my gosh, like I can't believe the balance is so high. Oh, whatever, let's just go out to eat. We've already got this much on there. It's a trap, and it's a trap that many, many, many Americans are in. And again, we're here to help if anyone needs it. Definitely know what incentives and features you're signed up for. If you have an annual fee, make sure it's worth it for you to have an annual fee. And if you cannot carry a balance on your card, do that. Don't have a balance if you don't have to. I have had people say to me a lot, well, I have to have a balance because otherwise it won't help my credit. And that is not true. What you should do is use your credit cards regularly, but you don't have to carry a balance in order for it to help your credit. So what I tell people as a tip is I'll say, you know what, put your cell phone bill on your credit card and just pay that every month when the bill comes in. Just pay the credit card. Pay it on time so you don't pay any interest or get any late fees. But You're showing you've used it, you've paid it back. You've used it, you've paid it back. That's how to build your credit. And again, don't pay your bills late. If you don't remember anything else I say tonight, remember that. You know, reducing your credit card debt, some things that you can do, review your statement to see what you're really paying. And if you're noticing that you're putting like food or apps or, you know, Netflix and all your TV watching things on your credit cards, you really need to try to get it to a point where you're not doing that, where those things are just coming out of your account every month and they're not just adding to your credit card debt. And the best way to do that is to do a budget and figure out, this is how much I take home, this is how much my rent is, my car insurance, my cell phone, Netflix, detail it all out. What do you spend your money on? You know, food, grocery store food, coffee, scratch ticket, cigarettes, whatever it is. Write it all down, get it all on a budget. One of the things I'll send our lovely educators tomorrow is a copy of a budget to send out to you all if you'd like to use it. And if not, no worries, but I always find it useful. It's hard to figure out what you're doing wrong until you figure out where you are. And see if you have any debt consolidation or refinance options that are available to you. For those of you that are homeowners, do you have any equity in your home right now? Bet you probably do, unless you bought it in the last 2 years. So maybe a refinance to take money out of your equity in your home and pay off your debts is the right move. Or maybe not. Or a debt consolidation loan. I love debt consolidation loans for multitudes of reasons. But with the debt consolidation loan, folks, you are going to take all the debt that you had on your credit cards, roll it into one payment every month at a decent interest rate that you know you're going to make the same payment every month. I'm going to pay $245 on this debt every month, and at the end of 5 years, it's gone. And that way you can cut up your credit cards or just have one for emergencies or something like that. Definitely make a plan. If you have credit card debt or other debt, make a plan and prioritize which cards to pay off first. Set yourself a payoff schedule, make it part of your budget, make it part of your monthly plan. Again, we're here to help you with that if you'd like. And you might have heard of Dave Ramsey's debt snowball, or another theory out there to pay off debt called the debt avalanche. They're both great ways to attack it. And again, we're here to give you any thoughts or guidance you need to tell you more about the debt avalanche and the snowball. So again, I'm going to send you out a budget tomorrow. Write it all down, folks. It is what it is. Don't freak out about it. Don't call yourselves bad names. And, you know, people that I work with call themselves, they say the most horrible things about themselves. They tell me that they're stupid, that they're worthless, that they're uneducated, that they're, you know, that they're just horrible. And I just look at them and I'm like, you're none of that. Okay, so you have some credit card debt. Who doesn't? Most people do, folks. It is what it is. It's no use crying over spilled milk, as my mother would say. So start writing everything down. This is what I make. This is what I owe in credit cards. This is what I pay every month, my car loans. Jot down any collection items, any past due items. Maybe you're 3 months behind on your cell phone bill. Write it all down. Start getting it organized. Once you figure out, you know what? According to this, I make enough money each month to pay all my bills on time and eat. So why is this not working for me? Again, we're here to help you organize it and give you some tips and suggestions. And I'm going to get into some of those in a minute. If you have debt out there, again, debt consolidation loans are a great option. Credit card balance transfers can absolutely be a good option. You might be able to get something like 0% for 12 months. Just read the fine print, folks, because most likely you'll have to pay a balance transfer fee of 2, 3, 5, 7%. Also read the fine print and make sure it does not say, if you don't pay this off in a year, you'll owe back interest. Not all of them say that, but some of them do. Just read the fine print. And again, I'd already mentioned a mortgage refinance if you're a homeowner and have debt, and or an equity loan. They're the same things. They use the equity that's in your home in order to be able to pay off high interest rate debt, and you'd be paying it off at a very, very low rate. And again, these are good options for some and not for others. Everyone's individual, everyone's situation's a little different. Some of the things that you can do, if you do have collection accounts out there, give those companies a call and say, all right, I owe you $1,000. I don't have $1,000. I might be able to get a few hundred I can give you. What is the lowest amount that you will take so that I can get rid of this? They might very well say, all right, yeah, give us $600 and we're good. And you're done. I had someone last year that owed over $4,000 on a PayPal credit card. They settled for $2,800. Now, not every company is going to do that, but it's worth a phone call, and it is worth a few minutes of your time, because you might be able to get money off. If anyone is interested in talking about a loan to pay off collection accounts, that's a great thing to do if you can do it, because again, like I mentioned, making payments on these collection accounts is great, but it won't fix your credit until it won't solve your credit problem until they're paid in full. So we will look to do debt consolidation loans and personal loans to help people pay off collection accounts. Our interest rate's 12.9. And again, everyone would get that rate if you're approved. So if that's you or someone in your world, reach out to me. We'd love to help. And I mentioned this already, some of the pros to doing a debt consolidation loan. It's one payment versus many. If you have 6 credit cards, you have to run around and make sure all of them get paid on time at different times of the month. Again, most credit cards have an interest rate of 20% or higher. So your debt consolidation loan should have a much better interest rate, and it's a fixed interest rate, folks. So, again, there'll be an end date. You're not going to just have that credit card and keep the balance is going up and down and up and down. And there's pros and cons to using a mortgage or an equity loan to refinance your debt as well. I won't go into all of them here tonight because of time. But again, there's pros and cons to doing that as well. Same thing with the balance transfer offers. Just read that fine print. But some people can really get some good offers, and they work out really well for them. So Dave Ramsey's Snowball method is here, and this is how the Snowball method works. And I have coworkers, I have clients that have paid off tens of thousands of dollars. My coworker and her husband paid off $90,000 in 5 years using the Snowball method. And what it is simple. What it is not always is quick. And this is how this works, folks. So you'll start by listing any of the debts that you want to add to your debt Snowball. You're going to list them here. And you'll notice that what you're going to do is list the smallest balance first. So you'll notice my American Express is on the top of my pile, and it has an $800 balance, and the bottom of my list is Discover with $6,500. And what you're going to do, you're always going to make your minimum payments. We know this, right? Because if not, your credit score is going to go down, which is not what we want. So, but maybe, you've gone through your budget and you've realized, I can make my minimum payments. I can make my minimum payments each month, and I still have $25, left over that I could put extra, towards my debt. So with Dave Ramsey's Debt Snowball, what you're going to do is you're going to make all of your minimum payments. On the smallest debt, you're going to add any extra money you have, maybe that extra $25. Maybe you picked up an extra shift at work, or you sold some stuff in your house and you made $200. Any extra that you get, you're going to put towards that smallest balance first. The idea is to build momentum, get yourself into a healthy habit of not spending money, but the exact opposite of that, getting rid of debt. So again, let's just say you found an extra $25 somewhere. So instead of making a $25 payment to American Express, you're going to make a $50 payment. And once your American Express bill is paid off in full, you now have an extra $50 every month that you've been putting towards Amex. So what you're going to do is increase your next lowest balance, the Capital One, with that $50. So instead of paying $30 for Capital One, you're going to pay $80 a month. And again, extra shifts at work, stuff that you sell, tax refund, whatever you can do. And you kind of get on a roll with it. It's I don't know if anyone out there has ever tried to lose weight. I most certainly have. I am a human yo-yo, okay? And I went to the doctor a couple of years ago, last year, and we decided I needed to lose 50 pounds. I did. I knew that. So I started my diet plan. Now, if I waited until I lost all 50 pounds to feel good about myself or reward myself, how long is this diet going to last? About an hour and a half, if that? However, if you need to lose 50 pounds, you notice that, after about 8 or 10 pounds, you're like, you know what? Like, my pants are fitting better. Like, I don't have to suck them in anymore. Like, this is kind of cool. And you know what? Someone stopped me in the hallway today and said, you look good. What have you been doing? And you get all puffed up, right? You get proud. And then when someone's ordering pizza for lunch and they say, you want pizza? No, I'm on a roll. I'm not eating pizza. I'm going to have my salad. It's the same thing with debt. When you are hyper-focused on paying off one debt at a time, and then someone says, oh, do you want to, go do a spa day or what have you? It'll cost $200 a person. You're going, no. Well, wait a minute. Let me see if I have the money in savings. Yes, then. But I'm not going to put it on a credit card because I've been hyper-focused on paying off these credit cards. There's absolutely truth to stress eating, stress spending. There's absolutely truth to retail therapy. When we shop, we feel good, right? We get a dopamine hit. Woo! You can also get one when you pay things off. So again, I've seen this. I have tons of people that would love to share their stories with anyone that is interested. Again, tens of thousands of dollars that people have paid off. Again, it hasn't been easy. It hasn't been quick, but they followed Dave's program and they just focus on one debt at a time and they make it work. So this is the end of my presentation here this evening. And I want to first of all, thank you and everyone on this call right now for spending time with me here tonight. And I hope that this was everything that you were hoping it was going to be. I hope that you got out of it everything that you were hoping to. But if you did not, if you have more information that you need to get and you would like to talk further, this is my contact information here. Actually, I'm going to give you my direct contact info. So again, my name is Megan. I can be reached at that email address and that phone number, as well as we can be reached at the group email address, Center FE, and that group phone number up here at the top. I will be tomorrow getting some information to everyone out there to send out to you, including a budgeting, including a copy of this presentation. And again, if you'd like to work with us, we're more than happy. We'd love to work with you.